Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Veron. It's my pleasure to introduce this new session of financial statements at the Peterson Institute for International Economics. And today we'll talk about Ukraine. We have two participants joining us from Kiev, two speakers, and I'm very grateful that they join us from a country which is at war as we speak. Oleg Churi studied at the Kiev Polytechnic Institute and also trained as a CFA, Chartered Financial Accountant, analyst. Sorry, I got the acronyms always wrong. He has worked in the banking industry since 1993, so the very beginning of the post-Soviet banking industry in Ukraine. First for a number of foreign banks, HVB Bank in Ukraine, and Ukrsib Bank, which is part of BNP Paribas. From 1999 to 2010, then for VTB Capital, Russian-owned bank, for 4 years. And after the events of 2014, he joined the National Bank of Ukraine, where he was initially the central bank, where he was initially head of open market operations, and then deputy governor until July 2020. Olena Bilan studied computer science initially, also at the Kiev Polytechnic Institute. She also got a master's degree at the Kiev School of Economics, where she graduated in 2002. She then worked for the Institute for Economic Research and Policy Consulting, a think tank, a leading think tank in Kiev, and also for the investment industry. In 2006, Olena Bilan joined Dragon Capital, an investment company established in 2000, and in 2009 she became the firm's chief economist and head of research. With that, Oleg, over to you.
Yeah. Hello, everybody. Good morning, good afternoon, or good evening. So I'm Oleg Churi. I'm a former deputy governor of National Bank of Ukraine. Thanks, Nicolas, for the introduction. I have a very short presentation. I told this presentation should be only 10 minutes, so it would be very short, and I will try to share the screen for the presentation. So my presentation mainly about policy response to the events happened in Ukraine since February. So I will start very briefly regarding macro. So basically, impact of the war on Ukrainian economy was very severe. So starting from physical destruction of production capacity, infrastructure, so a lot of industrial capacity was destroyed, bridges, power plants was destroyed. So we had the blocking of exports via seaports because Ukraine export a lot of grains and also metal products. So this export was completely stopped, but it was renewed in August. So we have a lot of internal and external refugees. Millions of people migrated to mainly to Western Europe, but also internally to the western part of Ukraine. So as a result, Ukraine lost access to international debt market, and we had all macro figures actually wasn't very heavily. So GDP, according to estimates, probably would probably drop by about maybe 30%. Inflation shoot up to also to 30%. Fiscal balance would probably be about 20% this year, and export would decline by about 40% by preliminary estimates. So I will talk about initial policy response. So what authorities did. First of all, central bank, they ensured the bank's financial system remain operational and liquid. So central bank suspended the inflation targeting regime and moves to fixed exchange rate. So it fixed it at pre-war level, and central bank used FX interventions to support the peg. Capital control measures were introduced, effectively banning repatriation, income repatriation to non-residents. Also investment abroad was banned, but restrictions covered not only capital account but also current account operations of individuals, banks operations as well. So regarding budget, there were some cuts, mainly non-essential spending like capital expenditures. So also the government, they provided some support to businesses and the internally displaced people, which increased spending, of course. There were also introduced some tax breaks, including import duties. This was happened during first couple of months of the war. Government resorted to monetization of budget deficit since there were not much options for the government to finance deficit, but also request for financial support from foreign partners. At the beginning, government continued to pay external debt abroad. Oops. So to address further challenges in the middle of the year, central bank had to hike the rate since inflation was shooting up. We had a very drastic situation with reserves starting to deplete very heavily due to central bank interventions. And central bank had to resort to refixing exchange rate to the new level to address accumulating imbalances. So they also continue further tightening and tuning on capital control. It affects mainly operations of individuals, so these people who are living abroad, but they using foreign currency to cover their expenses. Government decided to reintroduce import duties, which was decreased at the beginning of the war, but at the same time there were proposals to increase some taxes, but it was decided not to do so. In August, Minister of Finance decided to conduct operations with the reprofiling of external sovereign and some SOE debts successfully for sovereign debt, and government continued to rely on budget deficit monetization. At the same time, Minister of Finance paid very little attention to local debt market. How effective was the policy response? The key is that the financial system remains stable. It is liquid, and all operations continues uninterrupted. Mainly, it's partially due to experience which Ukrainian banking system had during COVID. So Ukrainian banking system managed to work online. So it helped a lot. Ukraine also managed to finance its war budget using foreign funding, but also mainly funding from central bank. Fixed exchange rate provides some kind of nominal anchor, although it is very much imperfect. We're having a situation where we have multiple exchange rates, so cash rate or gray market rate, usually 10 or 15% above official exchange rate. Regarding monetary financing, due to monetary financing, NBU now has very limited ability to fulfill its mandate for price stability. Actually, it's not feasible to print money on one hand and try to increase the price of the money on the other hand. So you can see from the graph on the left that monetary policy transmission actually is very much distorted. So when key rate was increased by 25 to 25%, so interest rates for deposits, for example, reacted only lightly. So that's actually creates a situation when we have negative real rates, which stimulate capital flight. At the same time, July devaluation and increased foreign support helped to reverse FX reserve depletion. So whereby in June, central bank sold approximately $4 billion per month. In August, this figure is only slightly above 2. So regarding financial sources, so budget very much rely on foreign support. so which account more than about 55%. These are foreign grants, mainly from US, also foreign loans, including loans from EU, and also IFIs like IMF, World Bank, and European Investment Bank. But government also relies heavily on NBU monetization, which account about 40% of financing this year to date. At the same time, I have to say that local market remains very much neglected. So we have rollover of only above 50% this year, regardless of all-time high liquidity. So you can see from the graph on the right that the portfolio of central bank increased almost twofold, whereby portfolio of other investors, mainly bank, actually decreased. We also expect. Sorry.
One question just of clarification. Where would the tax revenue fit into that picture? Because it's not in your chart. So can you give us a sense of how the fiscal revenue from taxes would compare to those sources of funding that you have in the pie chart?
I would tell you a little bit later, I think, on the next slide regarding tax revenues. But regarding financing, so we expect that the receipt of financing from abroad would accelerate by the end of the year and would amount from $10 to $15 billion this year. So regarding budget, so this is budget for 2023, but it's very much similar what we have this year. So we have budget revenue about 20%, budget expenditure for next year. This is draft budget which was presented recently by the government. Budget expenditure is about 40%. And gross financial needs for the next year would be about 26%, or about $40 billion. The thing is that according to budget and envisage that most of financing would be covered by our partners from abroad, almost 95%, or about $38 billion. And budget also envisage very low rollover of domestic debt, which is I think quite strange. So most probably the budget should fall. This $2 billion would be covered either by NBU or by local debt market. And also thanks to external debt reprofiling, so government would save about $3 billion in principal and interest next year. So what are the main takeaways from my presentation is that foreign financing is critical for budget financing and macro stability. Maybe not is in that amount as envisaged by the budget. So it's about $3 billion per month, maybe less, but it's still very critical. So grants, of course, are preferable. So we receive about 30% of grants this year, and next year probably it would be. We hope it would be more, since it's a big question regarding debt sustainability. So fiscal consolidation definitely is necessary, but mainly just should be done via revenue enhancement. So according to budget this year. They're going to increase taxes for fuel, duties for fuel, but I didn't see any more revenue enhancement. Most probably the budget would be changed in this respect. I don't see a lot of room to decrease expenses, since the country actually at the war, so we have quite substantial expenses to support population, to support war efforts, and I didn't see a lot of capital expenditures which can be cut in the budget of the next year. So what is critical? Monetary financing must be minimized, since it's very dangerous. It increases risks for financial stability, and it also makes monetary policy of central bank very much ineffective. Ministry of Finance should not forget about the local debt market. So we have a huge pile of liquidity at the local debt market, and this is local currency, so there is no exchange risk, and Ministry of Finance should pay attention for this market next year. Real rates must go up, but NBU must find a way to sterilize liquidity. So due to this monetization of the budget, so we have all-time high liquidity. So, but monetary policy transmission is very much impaired. So basically, it didn't translate to deposits. Maybe NBU should find the way using some unorthodox instruments to sterilize liquidity, like increasing maybe reserve requirements or selling bonds from their own portfolio. It looks like that the next exchange rate resetting is inevitable, since we still these imbalances would accumulate over time. But I think the main trigger for next exchange rate resetting would be reserve depletion. So this would be politically much more easier to change the rate if you have a reserve going down. And the last thing, which maybe it's more like a question. So is it time maybe to move to more flexible exchange rate, which would allow not to accumulate imbalances? Maybe central bank should think about kind of managed float. But again, this is a big question, since if you move to more flexible exchange rate, you might lose the nominal anchor. At least now we have this in terms of fixed exchange rate. So I would stop here. I think my time is up.
Your time is not up, because we'll come back to many of these issues. And thanks for a really all-encompassing presentation, quite a tour de force. Olena.
Yeah, good day, everyone. I think I will add a little bit to what Oleg said. I think that was a very good overview of the current situation, in the situation that we were over past 7 months. Just to put it into the context, yeah. So currently, 20% of Ukraine's land is under occupation, and this under Russia's occupation. And this 20% of land before the war generated, on our estimate, about 12 to 15% of GDP. So just 15% of the economy are just gone, because we don't know what's going on there. So a lot has been destroyed. And based on the World Bank estimate, there was a very comprehensive study that I highly recommend you to read, that was conducted together with Ukraine's government and our European partners. So they estimate the damages that has been done earlier this year on June 1, about $100 billion. And the reconstruction costs would be $350 billion. $350 billion, it's kind of nearly 2 times higher than Ukraine's GDP before the war. So the economic loss are tremendous. There was a huge outflow of refugees. Oleg said about this, but in terms of the number, based on the latest United Nations estimate, nearly 7 million people left Ukraine, and this translates into 18% of our pre-war population, excluding the territory that was occupied by Russia before. So the blockade of Black Sea ports posed a huge problem to export. So Black Sea ports were the major channel for exports. It's accounted of, I think, 80% of our external trade turnover before the war, and now it was closed until very recently, when there was a deal that allowed to export grain from Ukraine. And again, this background, I think that indeed economic policy response it just deserves applause. According to my personal belief, the central bank reacted. So the central bank was prepared and reacted on the first day of the war. All these restrictions and policy measures that Oleg described, just for you to understand, they were in place at the 9 a.m. on the first day of the invasion. And this really helped to maintain stability, to ensure that the banking system is fully operational. I think it's a rare example during the military conflict, during the full-fledged war. We didn't have a history of wars, fortunately, but the fact that the banking system was kind of fully functioning, all transactions were passing through, is a huge achievement. Then on the side of the government, I think it was also a very correct move to really ask for financial assistance immediately and to solicit as much financial assistance as possible. Answering one of the questions about revenues and spending ratio at the moment. So on the general government level, the revenue that the government is getting, they cover 55% of spending, so roughly half. So another half needs to be financed. And that was also a right decision to finance it partially with the printing money, which is the deficit monetization, because definitely the financial aid was from abroad, from our partners, was coming with delay. But I totally agree that this practice needs to be discontinued. So there was a huge initial economic shock in the beginning, but what we observe over since March, April is a sequential economic recovery. Unfortunately, there is very little data on the real economy published at the moment, so it's a big challenge for all analysts to really track and understand what's going on. But based on different indicators, what we see, there wasn't that the businesses and people recovered from shock. Then the territory in the north of the country was liberated in April, and this helped as well. So overall, we estimate that the Ukraine GDP declined by around 30% in third quarter of this year, compared to 37% decline that was estimated by the official statistical committee for the second quarter. So we see this sequential improvement, which is positive. There are a lot of people in Kyiv, as I may observe. On some estimates, there are 3 million people now back to the city. And before the war, the actual population was 3.5 million. So basically, many people returned. But we do have a lot of challenges ahead. Let me just quickly summarize them. Of course, the first challenge is to win the war, and we need weapons for this. But the second challenge, which is close to my professional life here and close to my heart, Ukraine needs to maintain macroeconomic stability. This is critical thing. If we lose the economy, if we lose macroeconomic stability, it will be very much difficult to win the war, nearly impossible. So what is needed to maintain macroeconomic stability is definitely to avoid hyperinflation, constant devaluation, avoid economic crisis. So, and what Ukraine needs for this is sufficient amount of financing coming regularly, insufficient amount to cover the budget deficit and to support central bank reserves. And in this way also to improve the confidence of the population and to curb capital outflows, which is becoming the major problem for the FX market at the moment. So the government has already requested or kind of asked our partners, not really requested, but asked our partners to provide nearly $38 billion in external financing next year. I think this amount may not be sufficient, actually. We may need more, but this amount, but at least 38 billion will really keep the country afloat. It may sound a huge amount, but compared to what Europe now spends on supporting their own consumers, population from this energy shock, it's not that that big. And if war is over, then definitely economic situation in Europe will be better as well. And as much as possible, it would really be to the benefit if as much as possible will be coming in grants. So if all the financing will be in loans, the 38 billion, then Ukraine's debt to GDP will reach 100% by the end of next year. So, and there will be a huge question about the debt sustainability. Then definitely the challenge would be to ensure that people who left Ukraine will be coming back, so the government will need to spend a lot on restoring housing because of this $100 billion of damages. The biggest share, I think $38 billion or something, or similar amount, is actually destroyed or damaged houses. Homes. And definitely then we will be talking about the general kind of reconstruction, but macroeconomic stability definitely is a key challenge at the moment. Thank you.
Thank you so much. Lots of challenges, obviously. My first question, and tons of questions certainly on my side. My first question is about the data and the statistics, maybe to both of you. How you mentioned the difficulty of statistics during wartime, Olena. How bad is it? Are statistical series broken? Is there still a functioning production of statistics? Can you give us a bit more of a context for those of us who don't follow the Ukrainian government statistics on a regular basis?
Yeah, thanks for this question. So we do have some data published, with mostly financial data. So we have all information on the budget, on revenues and spending, and the breakdown, except that the kind of military spending, definitely there is no breakdown for security reasons.
But is there a general envelope of military spending which is disclosed by the government, or
yeah,
there
is a total number. There is a total number, but total amount, but no breakdown into more details. Then we have all the data on Ukraine's external position. The NBU publishes balance of payments in a very detailed breakdown of the exports and imports and the capital transactions. I guess there are a lot needs to be kind of estimated, so that the NBU staff does out of their own calculations. But anyway, so that's generally no big difference from what we observed before the war. We have data on prices, on consumer prices, but nothing on producer prices. So we don't know what's going on, for instance, I don't know, in chemical industry, what's going on with prices on other goods, industrial goods, I mean. And the major challenge, and where there is no data at all, is, as I said, the real sector of the economy. So the State Statistics Committee stopped publishing all real sector indicators, like we don't have data on industrial production, retail turnover, this transportation, whatever. So all this has been stopped. Wages, unemployment, all labor market statistics is not published.
Thanks so much. This is very helpful. Oleg, on the statistical challenges, any additional points?
I can say regarding SPI calculations, so it's done by Ministry of Statistics, but NBU using also their own web scraping, and I can tell you that so it doesn't differ much. So it's very much similar. So and it's true that during the war, Ministry of Statistics they stop receiving statistics from the companies, and yes, that's a kind of big challenge. What Elena said, that they stop publishing because they stop receiving these statistics. That's an issue. Yeah.
On the point that Olena briefly touched upon, which is military expenditure, this connects, of course, with the whole budget totals, right? So can you give us a little bit more of a sense of how military versus non-military expenditure has evolved in 2022 so far, and also importantly in the 23 budget, what is the expected balance, and even how can you make plans on this? Because I guess this depends so much on largely unpredictable military development that it's not conventional budgeting, right? So maybe Oleg first, and then Olena.
As everyone knows, that Ukraine received quite substantial support, not only in terms of financing, but in terms of direct military support. It's not definitely included into the budget, so because it goes directly to the military. But in terms of expenses, so I would say most of expenses of these are salaries for armed forces. For soldiers, for officers, but also there is probably a large part of expenses also to purchase new equipment, to service equipment. But overall expenses, as far as I know, is about maybe half of the budget. So that's regarding military expenses of Ukraine.
Yeah, that's absolutely true. So on average, Ukraine spends about $4 billion on security and defense from the budget, and this is half of the total spending from the budget. Just
that's
for
every
you
month,
to have
right?
It's every month. It's $4 billion every month. It's before the war, the spending were 4 times lower. Like less than $1 billion per month that was spent on security. Defense is a broad sector, so it also includes like police, for instance, or emergency service. But that is what is really also becoming crucial now for security in the regions which are not under direct fighting. Yeah. And so social spending is the second biggest item on the spending side, and again on average it's $2.5 billion per month. And then we have this healthcare and education about 1.5, and the rest of the spending which are kind of very, very small. So that's like 3 key big items: security and defense, social, which also includes in this particular case, I also included pensions, all this social assistance, and then healthcare and education. That's a basic service that the government has to provide, pay to teachers and pay to doctors. So that's Oleg noticed before that, well, on the spending side, there is very little that the government can do to reduce them.
How has the war, sorry, go ahead.
Sorry, I just wanted to say that the proportion in the 2023 budget is pretty much the same.
Sorry, say it again.
So the breakdown in the next year budget is pretty much the same.
Okay. And how do the social and welfare and pension and education expenditures evolve as a consequence of the war? Because on the one hand, the war brings a lot of problems, so that means more expenses. On the other hand, there has been all this immigration, so I guess lots of women and children have emigrated in particular. Does that mean cost savings in some departments? Can you give us a sense of the expenditure dynamics in those different categories?
Actually, this social spending, they increased a little bit. So average monthly average last year was $2 billion US. Now it's 2.5. And healthcare and education, there were no major changes. You are right that many people left the country, but on the other hand, you know, nearly all schools continue operating in Ukraine, except for again this territory which is occupied. So they work either offline or in offline mode or online. So teachers are paid. I even know the cases where when teachers also they have families and they left the country, but they continue teaching from abroad. And also the government continues paying salaries on the occupied territories. So the salaries don't always reach those people. They are accumulated on their accounts. So there's so far portion of this spending sit in the banking system, but this is a kind of that how to say it, it's important from the ethical point of view to continue paying to the people, because it's Ukrainian citizens that have been in a very, very difficult situation now, having very little access to even basic services on these territories. Once this territory is liberated, teachers and doctors will get their salary for the whole period immediately from their accounts.
So basically, this is something I had never well understood. So the banks, the Ukrainian banks, have kept their operations in occupied territories, but they kept them virtually, right? So there is no access to the branch. Maybe the branch is no longer extant at all, but it exists in the information systems of the banks and with the account still intact, right?
Right, that's right. So it depends on the particular city and town and the occupied territory, but in some cities, there are schemes that allow people to get money from their bank accounts. So there are people who can actually cross the front line, withdraw money from ATMs in hryvnia, go back to this occupied territory and give this cash to its owner.
May I also add that people also use P2P payments, so from card to card, and so this is done quite extensively, since in this way you avoid using cash, which so it's quite difficult to take from to occupied territory or other way around. So people they are also using these P2P transactions.
Just to clarify, and I apologize for my complete cluelessness about wartime conditions. It's difficult to use cash because the Russian occupation authorities discourage the use of hryvnia or the Ukrainian currency, or it's just because cash is cumbersome and takes a lot of volume and weight?
So it's
Yes,
difficult
to
it's difficult to move, of course, to move cash from the front line in and out. So it's quite complicated. That's why people resort to some different schemes, including P2P payments. Yeah.
But they can use hryvnia in the occupied territory, or this is also something that that is impossible, at least in some places.
As far as I know, it is possible in some places, but looks like with this annexation of territory, so it like happened like in Crimea. So hryvnia from the beginning was used as a means of payments on that territory, but then it was completely stopped. Yeah.
And is there, just to continue in this chapter of occupied territory finance, is there a lot of use of crypto and cryptocurrencies, or is that not really a thing in the daily life of people, as you can observe?
Of course, they use different schemes, including such instruments like cryptocurrencies. That's for sure.
Okay. Olena, any additions on that?
Well, to be honest, very hard to say what exactly is going on. But as far as I
Right.
understand, yeah, it's possible to use hryvnia in most of the territory, not everywhere. And on crypto, well, I really don't know how to track it, but probably some people do use it.
Indeed. One more question about the banking system, because as both of you emphasized, and also as Valeria Gontareva emphasized when she participated in a session of the same series in April, it's been one huge achievement of the Ukrainian authorities to keep the banking system running, despite the shock of the invasion, in many ways operational and also in terms of collective trust. Can you give us more of a sense of how the banking system looks like right now? First, how much of it is still private sector compared to the state-owned banks, or is basically all the banking system for practical purposes state-operated? And also, how does bank supervision and regulation, capital requirements, and all that function in a context like the current one? Maybe Oleg first.
Yeah, thanks. So regarding banking system, it was very much very good capitalized and liquid before war. So after cleanup of banking system, it's absolutely different situation in comparison with what we had in year 2014, when we had a lot of cases of insolvency, problems with liquidity, etc. Presently, banking system actually over liquid, both in local currency and in foreign currency. We don't see any kind of outflows in local currency, in foreign currency as well. On top of that, apart from cash liquidity or accounts with central bank, so banks, they have quite a lot of government papers in their portfolios, which they can use to receive liquidity support from central bank, and they did use at the beginning of the war. So basically, central bank, they elaborated some new instruments which they launched at the beginning of the war to support banking system. For example, refinancing facilities without collateral. But NBU actually stopped doing this because there was no demand for this. So banking system is really very much liquid. Basically. Yeah,
I asked about the divide between state-owned banks and private sector banks. Can you comment on that?
Yeah, in terms of total assets, state-owned banks, they account about 60-65% of the total assets of banking system, with foreign banks about 25%, and the rest about 10 or 15% are privately owned banks. But I have to say that all these three parts of banking system works okay. So we had only one case when a small bank became insolvent, and that was I would say quite idiosyncratic case. So overall banking system, I don't think they have immediate problems. Of course, they have problems with capital, no doubt. That most of banks, if you calculate all provisions that they need to create for bad loans, most probably capital would decrease considerably. There might be the case that many banks would have negative capital, but again, this is not the issue as of today. So central bank knows how to deal, how to address this particular issue, like we did in year 2014. So they would need probably after war. So they would need to do stress testing, define requirement for capital, and then provide banks with kind of schedule for recapitalization, which would last for 2, maybe 3 years. I don't know. So depending on the extent of capital demand. But overall, so we do not see any particular problems with banking system.
Olena?
Yeah, that's generally, I generally agree with that. The one point that I personally considered very interesting that heard from bankers that that the payment discipline or loan servicing discipline is better than it was during the previous crisis. So definitely many companies just cannot service their bank loans, but those who can, they continue. So they don't try to avoid, they don't try to economize on the on this particular spending, and that's very encouraging. In general, there is kind of an overall kind of patriotic mood in Ukraine, which with people and businesses trying to support each other. So it's an interesting development with the loan servicing that will probably result in smaller increase in NPLs after we will have all the data available.
That's remarkable indeed. Oleg, you mentioned it was actually a main message of your presentation, as I heard it, the importance of the local debt market and the fact that the government may want to rely more on the local debt market. Can you give us a little bit more detail on what you have in mind here? Who would be the investors in local debt? Are you thinking more of households, of financial institutions? Can you tell us more kind of a concrete sense of what you would see as an avenue for further development there?
Well, historically, the main investors in local debt market were banks, which account usually 80-90% of the total debt. At the same time, we saw substantial interest of non-residents before war. Of course, you cannot account on non-residents in this situation, but during first months of the war, there was kind of patriotic movement. So Minister of Finance started issuing so-called war bonds, and a lot of individuals started investing their savings there. The problem, what I see here, is that the interest rate which Minister of Finance offer for such bonds is such low that so it's about 10%, maybe the maximum. They increased recently to 16% for 1 or 2 year bonds, and you see with inflation running about 30%, you would have deeply negative real rates. So that's why you should also rely not only on patriotic kind of approach, but also you should attract individuals, people using at least interest rate which cover inflation, or at least partially cover inflation. It's also interesting development we see in Ukraine that so we have quite good solutions for online purchase of government bonds using smartphones, computers, or whatever. And these solutions are already offered by a number of banks. And in terms of number of investors, we see a quite substantial increase. Maybe it's not about volumes, but in terms of number of investors, number of transactions, so it's really shoot up. I think to increase volume, Minister of Finance has to increase rates. So we have basically everything for this. So we have liquidity, we have people who like to invest their savings into local currency debt market. But so far we only missing one ingredient. We need interest rates which protect your savings. Yeah, that's the key.
Now, how do you view that challenge?
That's very interesting. That actually, despite all the problems and challenges, there is a policy debate here in Ukraine about what the finance ministry should do, what the NBU should do, and where the whether the finance ministry has to increase the placement yield for government bonds or not, because the argument on the side of the central bank that yes, we need to ensure the stability of the exchange rate, and for that we need to offer people and businesses and save an instrument, a financial instrument with a sufficiently high interest rate that would really exceed the inflation expectation and exceed devaluation expectation. So it would be profitable for someone to buy, for instance, government bonds with 25% yield, instead of buying dollars and sitting on those dollars waiting when the NBU would devalue it next time. That's one argument, but another argument from the finance ministry that, okay, we can do this, but then what will happen with our debt to GDP ratio? And we cannot really restructure domestic debt. If we do it once, then we will destroy the confidence of the population and the banks and businesses to local government bonds for years, and we will not be able to raise any money in the future. So far, I think the compromise has been found thanks to the inflow of foreign support that is everyone is expecting to accelerate in the first quarter of this year to $5 billion per month, from about 2.5 average that we got earlier this year. So the finance ministry will probably not increase the placement yields for the government bonds later this year, and will not have an issue with financing the budget deficit. But this question remains on the agenda.
What do you make of that argument of the finance ministry, that they don't want to raise too much debt because they would possibly need to restructure it, and that's too much of a risk?
No, it's not about raising too much debt. It's raising very expensive debt.
Right.
Because what now the debt that is currently provided to Ukraine is provided on very concessional terms. That the interest is maybe 1, 2, maybe up to 3%. 3% is probably maximum that we are paying now on this.
Yeah, but isn't it a bit the same thing, right? Because if I follow the argument that Oleg gave us, if they were to raise the rate, they would also get more volumes, no?
They will get more volumes in local currency bonds, and they will, in this way, be able to go forward without the NBU support. See, so that there will be lower or actually no monetization of budget deficit by the central bank.
So indeed, it is a trade-off between, in effect, the quantity of debt that they would raise compared with other sources of financing, and I understand the argument that if there is, a large volume of domestic debt which requires a lot of expenses to reimburse, that would create a complicated interaction with the whole foreign financing discussion. So I'd be interested in Oleg's view of this trade-off.
Yeah, just maybe another point is that the debt that is local currency bonds that are placed at the primary auctions, they're also very short term. So definitely, given all the uncertainty, local players, local market players, they're not ready to invest into something more than 1 year, than matures in more than 1 year. Yeah. So that means that if a lot of debt is raised now, then it will need to be refinanced next year, and that will increase a kind of refinancing risks. The money printing is done in a way that the NBU is buying government bonds from the finance ministry, but those bonds are very long term. There's 30-year maturity. So that's another argument that is kind of part of the story.
Oleg?
Look, there are a number of arguments which you can use for the discussion. If you look at the local currency debt, so you don't have these FX risks. And due to recent devaluation, but by 20%, all FX debt started to be more by 20%. On top of that, so you have a huge pile of liquidity at the local market, and this liquidity goes not to Ministry of Finance, it goes directly for central banks for this liquidity absorption operations. And after that, NBU using its own liquidity, actually printing money to purchase, to monetize debt of Ministry of Finance, which is quite, looks from my point of view, not very efficient, frankly. So if you are talking about short-term debt, and if we think that this liquidity would stay for some time within the system, so I don't think there is a big risks for rollover. On top of that, I think this would be quite an interesting discussion, not only between NBU and Ministry of Finance, but also with a potential program with IMF. I think it would be a quite interesting topic for discussion. I think they would use their arguments to convince Ministry of Finance to borrow locally as well, so without having FX risks. So, and basically, the strategy of Ministry of Finance was to increase share before war, to increase share of local currency debt rather than foreign currency debt, and they were quite successful in this. But this trend now is actually somehow reversed.
Teresa Terminacian in the audience is asking why not auction inflation index bonds, which would be a way to resolve some of the trade-off here. What do you think, Oleg?
It might be the case. Basically, there are inflation-linked bonds which were issued, I think, in year 2017 or 18. So NBU made kind of reprofiling of that in their own portfolio, and NBU received the inflation-linked bonds. Although these bonds are quite long-term, but I think it might be interesting just to diversify instruments which issued by Ministry of Finance, and try to offer these bonds to investors. It might be not only inflation-linked bonds, but also bonds linked to some local currency benchmarks, which have a floating interest rate, and which would decrease interest rate risk for Ministry of Finance. So they would not locked in at a fixed interest rate for long, but they would receive liquidity, and they would decrease their interest rate risks.
Many thanks to both of you. Obviously, there are so many other issues we would like to cover in this high-stakes, fascinating situation of Ukraine at war, and with all the support that many of us want to provide to the extent possible to this effort. One issue that dominates the conversation, obviously, is the foreign financial support, which we will keep debating in this series and elsewhere. It is, together with, obviously, the military developments on the front lines, one of the major parameters. But I think on the domestic situation, I, for one, have found your explanations extremely illuminating and helpful. The next session of the financial statement series will be on October 12. We will discuss financial centers in Asia, and particularly with a perspective from Tokyo, but also Singapore and the different competing centers in the current situation, with also what's happening in Hong Kong. Thanks very much to everybody in the attendance for their engagement and participation, but thanks particularly to Olena Bilan and Oleg Churi for joining us from Kiev, from Ukraine at war, and we wish for the best. We are very grateful for your participation today. Thanks.
Thank you.
Thank you. Bye-bye.